Welcome to the Sharon Partners quarterly market update for the December quarter 2025 and the full year. I'm joined as always by Dr. Steve Garth. Steve, thanks for joining us.
Yeah, thank you, Kim, and Happy New Year to you.
And Happy New Year. Steve, what a year it was. We had a pretty good year overall, but we definitely had some bumpy bits along the way. What can you tell us about how equity markets performed?
When you look at the chart here, we're showing both the Australian and the US stock market over the course of this year. And you can see some pretty big bumps in there. The first one, of course, is in April, where tariffs were announced. Markets fell by about 10%, and then they all bounced back when tariffs were on pause. And in fact, by the end of October, Kim, markets around the world, including our own, were hitting new highs. And then it all kind of ended in November. There was some dodgy inflation prints coming out, both here and in the US. Now, the US recovered, and you can see, despite the wobbles in November, it's gone up, whereas Australia taken a much harder hit with the wobbles. So overall, Kim, not much of a quarter for Australia. We're down by -1%, but pretty good year, up over 10%, which is higher than the long-term average in Australia. And when you look at the US market, once again, they're up nearly 18% for a US investor over the course of the year. So another very strong year there.
And Steve, let's go straight to bonds. What can you tell us about the impact of 2025 for bonds?
Yeah, so a great way to look at this is through yields. Everyone thinks that bonds don't move. You buy a bond and it just sits there. But in fact, bonds are completely reliant on what yields are doing. So here, Kim, we're showing Australian and US yields. And you'll see sort of a similar behaviour in a way, that they're both correlated for most of the year, a few bumps along the way, but then you see this diversion happening in November. And once again, that diversion where Australian yields have gone up and US yields have kind of flatlined, all got to do with interest rates. When you look at the returns, guess what? When yields go up, bond prices go down. So Australian bonds, not a great quarter, an okay year, but a really good year for global bonds, which are mainly made up of US government bonds. So not a bad outcome for bonds either.
And Steve, that disparity that you mentioned that we're seeing, is that related to inflation and to expectations?
Yes, it is, Kim, in both markets, the way we've seen that dispersion in both equities and in the bonds. So when you look at this chart here, I'm showing how interest rates have gone over the last 5 years. Starting in 2021, when interest rates were zero, you might remember that.
Do.
And then US shot up harder and faster than Australia. They got a rate to over 5%. Australia lagged a little bit, so probably no surprise we're slower in coming down. And right now, interest rates are pretty much the same in Australia and US. So why the dispersion? It's because the expectations of what's around the corner. In Australia, the markets are saying we're not expecting any more rate decreases. And in fact, we expect markets to be on hold, or interest rates to be on hold for most of this year, with the next rate change to be upward in Australia. In the US, however, they're saying, look, while we're getting close to the end of the cycle, we're still expecting another rate rise this year, and possibly one next year as well. And if Donald Trump has his way, there'll be a lot of rate cuts in the US. So markets have got different expectations, and that's affecting the bond market and the equity market.
I suppose time will tell. Now, Steve, so what does that all mean then if we look at the impact for a client that's been invested in a diversified portfolio through 2025?
Yeah, great question. So what I'm going to show you now is how the major asset classes have gone for an Aussie investor, starting with Australia on the left-hand side there, already mentioned, up 10.3%, fantastic. The developed markets, this is unhedged, developed markets up by 12.5% in Aussie dollar terms. The hedged version of that is even higher, about 18%. And then emerging markets, which have been a bit of a laggard for a few years, they're up 24%. So all in all, if you're a diversified investor across those asset classes, it's been another fantastic year.
Well, we definitely like our investors to be diversified.
And happy.
And happy. Now, Steve, I think, we're filming this in January 2026. The headlines at the moment are dominated by all the talk about Trump in Venezuela, taking over Greenland. I think it's worth sort of asking the question is how does that impact expectations?
Yeah, that's a great question. It's sort of difficult to see. In terms of equity markets, it's actually got almost no effect. It does affect certain assets. So gold tends to keep going up when there's any sort of conflict. Oil's actually been going down all year, and now oil's got a little bit of a spike because Venezuela is major oil producer. And same with Greenland, by the way. So there are certain assets that get affected by these moves. Overall, the overall market seems to shake it off, unless, of course, things develop into something really serious where other countries got involved and said, wait a minute, you can't do that. I don't think that's going to happen.
Well, I think that's somewhat encouraging, but of course, we never know what's going to happen next.
We never do.
We never do. And our philosophy has always been and will always be that the best course of action is to maintain a disciplined approach and a good, diverse asset allocation for whatever happens next.
That's right, Kim. Absolutely.
Steve, thank you so much for joining us for the wrap up of 2025. We'll look forward to your commentary in another quarter.
Thank you, Kim.